Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. It is the witching hour at my house. The cat's been fed and occupants are getting ready to go to sleep, and the cats are nuts. So who knows what happens? If you've seen any of my previous videos, you know that I love strategy and targeted strategy, and that awareness is key because I'm going to sift through an email I got earlier this week. Um, Reminders, this is an unedited video. Who knows what you'll hear in the background as I film these in my house? Like, who knows what cat will make an appearance and what noise you'll hear? I am showing our strategy of using closed-end funds, and I will attempt to briefly go through that. And then I'm not a financial advisor. I am a financial strategist. So as I make these videos on normally breaking down financial memes, excuse me, normally breaking down financial memes, uh, tonight I'm breaking down an email. And it's not my intent to slander anybody. Everybody's got their own strategy. Uh, Memes are hard to figure out strategy. It's just, pretty pictures on a page. Today is an email that we're going to look at a headline and then just this little snippet. Uh, but I'm interested in separating out good from bad advice. And I think that's important because none of us want bad advice. So let's get into this. I'm going to first go through, excuse me, probably give you a basis of closed-end funds. So this is our master list of closed-end funds, all 422 current files or current funds. Everything in white and gray gets updated monthly. Everything in purple, green, and blue gets updated weekly, and we own everything in blue. Um, of the 422 funds, maybe 80% are currently discounted or in some level of discount, and the average yield across all categories is 8.67 as of Monday or MLK Day. So discounts off to the right. This is what everything means. So 3 asterisks is a buy alert, meaning the current discount is double the historical discount and it's greater than the 5-year discount. 2 asterisks is a dollar cost average alert based on what we already own. And then a single asterisk is tracking. And there are a lot of files that there are a lot of funds that don't have any reference. So I update them, but that's it. And then all these little earmarks are current data tracking on the current discount related to the fund. So if we scale all of these, or actually, yeah, so if we scale all of these, the reasons why the ones in gray are gray, part of the reason, either A, up here, they don't meet these parameters, so less than a 6% yield, or they're greater than $16. The other reason would be based on their pay scale, or based that we've already owned the fund and don't like their strategy. But I mean, those are significant discounts. And the way discounts work in relation to closed-end funds are called closed-end funds because it's a closed system. If you owned, or if you wanted to buy a single share of Microsoft or Coca-Cola, and for whatever reason they ran out of shares, they could simply pluck a new share out of thin air, write it down on a sticky note, and hand it to you, and it would be a share of that company. And it would not impact the current value of that company. But in closed-end funds, it's a closed system. So there are a limited number of shares. Now there's millions of shares, but there are funds who are typically in a premium range. They're always in high demand. Right? Anything over break even at zero, that's actually break even. Okay, you're paying more than what it's worth. So if a fund ever sold out of shares, you would have to find somebody willing to sell. So you'd have to offer more than what it's worth, right? And hope that somebody would sell. So when you get discounts like this, that just means instead of paying $1, you're paying 56 cents or 44, almost 45 cents, 55 cents instead of $1 for that top fund. And that's amazing, right? But on our end of things, we don't want a single year-end payment. We want consistent monthly payments. So my focus, our focus has been monthly payers. We own some quarterly funds, and I'll be straight up honest. This is our portfolio. This is our portfolio and everything we own. When we bought it, how much, you get to see our strategy evolve over time because we have never paid a premium, but at the same time, we've cut it close a couple times on breaking even, but we have never paid a premium when we bought these funds. You get to track progress over time. Um, but yeah, this is all of our portfolio factored out by payment cycle. I like to track shares, but our overall investment, annual dividend compared to our overall yield, uh, what we've made so far, what our overall dividend return of investment is so far. So in getting into this, the email I'm going to reference talks about a closed-end fund. And we have a specific strategy on how we're buying closed-end funds. We have a self-managed portfolio on Webull, and we only buy closed-end funds. We say we started off, I still do, we still take the advice of the contrarian outlook team, but when we started off, we looked at funds that were double the historical discount, but at the same time, we added an additional filter. We wanted more stringent parameters, more bang for the buck on our investment. So we've tweaked their system, made it a little bit harder to find funds, both like qualifiers, I guess you could say, like of how to qualify funds, but also as we look at different, it's not so much different sectors, but it's like consistent paying dividends. Um, so everything we own is in blue. Green is interested for one way or the other. Purple is recommended by somebody we trust. Gray is filtered out, and then white is just, it stays on the page. Now, I say all of that because we're going to look at a specific fund that I was emailed about. So I updated this on Monday. I got an email on Monday, I believe, 14th, Sunday. So still the same rates as Monday because the market was closed. With this, it says, I'm betting on America with 18% yields and the fund. And I don't pay for these. Like I get the free emails and I get a ton of emails. But I get the free emails with the headlines and I do not get to see the entire article. But I don't need to because they gave the fund, they gave the ticker and they gave the yield. And since I've got the data, I can just come look at it. So it pays monthly. It's a really decent price. But it's over, like you're paying more than what it's actually worth. That's the current price. That's what the company's worth. You're paying more. So let's see what's inside of it. So Morningstar's got the best free all-inclusive. It's easy to update data based on cefconnect.com. But if you want to sift into funds a little bit more. Morningstar is the best way for that, or at least for on my end of things that I found. And it'll show you how much of the fund is bonds or general stocks, other holdings. And it'll show you the top 25 of everything. And if we come over to CEF Connect, Closed End Fund Connect, you can look at the overall pricing. So, I mean, on average and historically, the fund is premium and pretty significant premium. We go to overview, we look at the overall price. Yeah, so it's still selling underneath what it sold pre-COVID. Uh, so in that regard, it's a good buy. It's a good buy based on the overall dividend and the payout rate. It's primarily bonds. Structured well seems to be. You can look at the distribution history. So pre-COVID, it has a rising dividend. It's not quite up to what it was pre-pandemic, but you're paying over. So instead of paying $1 or less, you're paying $1.11, which is even more than it was on Monday. On Monday, it was $1.07. Today, it's $1.11, and you're paying for more than what it's worth. Now, that all matters because you have to know your strategy. Our strategy is never pay premium, consistent dividends, 9% plus dividends. Lately, we've targeted more monthly dividends instead of quarterly or that off quarterly cycle. And it's a portfolio built for long term. We do have a couple hold till 20, maybe a little more than maybe we've got 5 or less funds that are hold till 20% and sell. 2 are currently marked for uh, sell for sure. The USA fund and the HQL fund are USA pays 1369, so it's a alternate category 3. HQL fund might pay the same. It used to be 36912, but then Aberdeen bought it out and manages it now, so it might actually turn into a 1369. I don't know yet. But both of those funds are drip funds, but they're automatic dividend reinvestment programs, meaning they pay you a dividend and then they automatically take it back and reinvest it in the company for you. Now, if you like the company and all that stuff, you could argue for it. But me, I want cash in hand. So if you're paying me a dividend, I want to be able to keep the dividend and then reinvest it on what I want to spend it on, not what the company wants me to spend it on. So in a drip program, you're essentially buying down your overall price over term. But that only matters when you sell. But on the month to month side of things, you're not collecting that income because it is income. You're not keeping the income. That's, hey, we paid you this dividend. Thank you for owning the company. But hey, we're just going to take it back for you and reinvest it for you, regardless of what you wanted to do. And that doesn't fit our strategy. I mean, we want cash in hand, not cash reinvested where we don't want it reinvested. And that's not to say they're bad companies. It's just that I want to be in charge of where we're reinvesting money and reinvesting all of the money besides losing out on whatever the dividend is. If you're building consistent monthly income for your retirement, having those companies withhold the dividend from you doesn't help with consistent monthly income. Um, but your strategy is important. So just because someone says, hey, it's an American-based company, which I like, and it's got this fat dividend, which I like, and it pays monthly, which I like, my strategy doesn't line up because I'm unwilling to pay a premium. I mean, if it dips, which it does dip, but when it dips, that's the time to buy. The other part of this is it's predominantly a bond portfolio, and the bond boat sailed at least 6 to 9 months ago, if not longer, and it docked already. like it was out to sea and chucking along. And then between the Fed rate and the interest rates, all that stuff, that bond boat has docked. And now that it's docked, now Bloomberg's like, oh my gosh, look, bonds are amazing. And everybody's jumping on. And that company I just showed is also now climbing on board. But the problem is the boat's not moving. Bonds overall, you're going to pay more than what they're worth. Now, if you can find some on discount, that's a little bit different matter. And on our end of things, it's not just that they're on discount, because there are a couple funds with bonds that are on discounts, and some are always on discount. The discount never really seems to change. But you're looking for a bond fund who's willing to close that discount window. And there are a couple bond funds around that are doing that. One in particular, and one that we own. Um, and if you want that info, I mean, if you paid attention to the share screen, you saw this. But just in case you didn't, I will pop up the video I did this past week, really from, I want to say I made it Monday. I will pop up the screen based on the video I did for the portfolio tab. These were my top two funds for the week. And it comes down to what you have to invest. Me personally, I like to buy things in sets of 50 because it makes it easy on the math. We own this one in blue. We don't own this one. This one does have some bonds to it. This is real estate, energy, utility bonds. So you kind of have to look at not just the existing market. You need to be able to project where you think the market will go. As an uncle of mine says, the market does not look at today or tomorrow. It looks at some point in the future, 5, 10, 15, 20, 30 years in the future. So where do you think the market will go? Because even the people who bought and sold stuff today aren't looking, they're looking at historical data of what to buy, of what and when to buy. But of how the market did yesterday is just a reference for how it will do tomorrow. Like, here are all these funds data from yesterday. This is the data for today. Here's where we think it's going to go tomorrow. And they're buying and selling based upon where they think the market's going, not where it's been. So of these funds, you can run a Morningstar report free of the, say, the top 25 components of each of these funds. Me personally, this fund is invested in solar among other utilities. Now, me personally, I'm not a urban area solar person, because unless that solar panel is tied into your existing electrical component for your house, you're really just a solar farm for the power company. But if you live in the rural areas, pick your rural area, you can solar power your house and live off grid. I mean, you could do pool pump, depending on what you're burning inside the house, depending on what you're using. You can go solar in a rural area and be completely off grid and live pretty comfortably. That has use. I just don't want anybody telling me that I have to go solar whether I like it or not. Uh, this company we own, bonds, utilities, energy REIT. The closed-end funds are structured like mutual funds. You get a ton of access. You just get a better dividend, and you get it on discount. Um, and I like buying in sets of 50, not 5, 50. So based on the money we say, the balance of our account, based on what we have, of the two, I could either A, buy 50 of the one we already have, or B, I could wait, collect the dividends, and that price, yeah, that price will come and go, rise and fall, right? But then pending the next dividend payment at the end of the month, maybe we can snag 50 shares of that. Um, maybe not. But if you want bonds, then you need to find a fund that is discounted. And yeah, this number is different today. But what this is in relation to is this number based on Monday, when we were off on Monday, or when the market was closed on Monday. So this negative 29% discount is like buying this fund for 71 cents instead of a dollar. So company restructured, but the 3-year data, which there should be 5-year data at this point, but the 3-year data posted is that it's normally at 23. I get that it's not double that, but on the shorter window data, I try to go above that. So 29% is for sure greater than 23%. If you want more of that, we can look here. 5-year data is still not posted, but it should post by end of this month, and we'll get a much better picture of this overall scheme. Although I would still say we're kind of right in here. So if you want bonds, my advice, find a closed-end fund that is on discount and that fits those discount parameters, like those buy alert parameters, something that is greater than the historical average, something that is something that's twice as much as the historical average for the long-standing funds, but that it at least is greater than the 5-year data or greater than the 3-year data to get the best bang for your buck. Because whether it's at the grocery store or gas, I mean, people use that gas app for a reason. If you get 5 cents off, that's a lot better than right paying the exact price at the pump. So the question is, would you rather pay more for what it's worth or pay less than what it's worth? Because either way, when that discount, so the discount window, right, you're hoping the discount window closes. But if that's break even and you're up here, you're hoping it goes a lot higher, especially if you're doing the buy low, sell high. But that's the other part of our strategy. We're holding funds. Now, some are marked for sell, and they're, I won't say cyclical, but um, something we can buy, make profit on, and then kind of push that money forward or swing that money forward. But a lot of the funds we have, the vast majority of our portfolio, is we're going to hold those funds and slowly add over time to where we increase our overall dividend payout, but we retain the funds. So if you're buy at a point and sell at a point, you could buy it at currently it's 1.11 for OXLC. So if it hits 1.2, are you going to hang out, or if you're going to sell it and make that gap, or do you wait for it to drop below a dollar, or right, drop below break even? So now it's 5 cents off, and then it scales up. You have a greater gap of sale, or you just get a better overall return if you hold it. So it's all about strategy, and it's all about knowing yours. And when you get more advice, whether by email or by video, whenever you get more advice, it's being able to sift that out compared to your strategy to see if it's a good deal for you or not. Not everything flashy and shiny is good. Not everything dull and mundane is good, or not everything dull and mundane is bad. You just have to know your strategy to be able to sift through everybody else's advice so that you can figure out what the best thing to do for you is and what that looks like. And as for that email, that advice, that strategy does not fit with ours. So for us, not a great advice, but it does make for great video content. So if you do like the content, consider subscribing to my channel, hit the like button, and then head over to Facebook and join my group there called Navigate Your Finances. As you face your future, whatever that is, you are the captain of your ship, and that ship will go wherever you steer it. So make sure you know where you are, Make sure you know where you want to go and make sure your ship is pointed in that direction. So, whatever you have for the week, I wish you well. And in the course of your journey, you just gotta remember anything that you want is possible, but it's not gonna happen. It's not gonna manifest on its own. So if you want something to happen, like if you're looking for a specific outcome, you're gonna have to change your response and improve your response to get that improved outcome, meaning it's not gonna happen on its own. So make it happen. Daniel Young signing out. See y'all on another video. Bye bye.